Hi, everyone. Welcome to another week of The Week Ahead. I'm Andrew Simon, CEO at MacroHive, and I'm joined by my very esteemed colleague, Dominique, in looks like extremely sunny LA. My screen, for those people playing at home, is just a background. Unfortunately, I'm not in San Francisco. Actually, it was pretty beautiful London today. How are you doing, Dominique? How's LA?
Oh, fine, LA. It's another beautiful fall day. I'm at the farmer's market, enjoying myself.
Okay,
So ready to discuss the many woes of the US economy and the US central bank.
right. Have you brought your as Twitter would say, your Weimar Republic barrel of dollars to pay for strawberries and blueberries at the farmer's market?
Well, believe it or not, but even the farmers, even the organic farmers these days are going with e-payments. So you can
Uh,
shop cashless.
okay, so even if they go
All
to
right.
100,000% inflation, we won't have
Uh,
to carry.
absurd, absurdly expensive.
Yes. Um, okay, as we always like to do, let's kind of recap. And as we've said for every week this year, it's certainly been a super interesting week. I guess this was the week we would probably say, and um, the pivot talk was probably the highest we've heard, and probably since June, I would say. And I think clearly you have all did a relief job with our clients and investors, telling them there's no signs of anywhere near of that at the time. And then obviously the markets started, equities and bonds started selling off and culminating with a pretty ugly Friday post payroll. So maybe kind of start off kind of what your take of data, any Fed speak, market reaction for last week.
Sure. So, the payroll was as I expected, perhaps less than expected in terms of wage growth, but I'm starting to have some views on why that is. But basically, we still get very, very strong growth in labor demand. We are in terms of year on year growth pace, it's 4%. It's twice as fast as labor supply. And in fact, participation is not increasing.
Right.
There's
It
no
actually
sign.
like slightly down, which was
Yeah, and which
bad.
defends my
Bad.
expectations. What I think is going on is that people think that they are not being paid enough to work, so they are voting with their feet in deciding not to come back to work. And so I don't think this is going to change unless we see a significant increase in real wages. And to me, this was the mystery of the NFP because the strong headline number I expected. Um, wage growth is too low relative to the how tight the labor market is. And what I think is going on, and I am planning to write about it soon. Well, my favorite activity, trying to unravel the mysteries of the US. No, but seriously, what I think is going on is that you really have a dual structure in the US economy. You have the deep pocketed dominant players like Amazon who can afford to pay $20 plus benefits for starting salaries. And then you have the much smaller firms that are being squeezed. And that's quite well documented, actually. And there is more and more awareness of this lopsided nature of the US economy. But what is going on is that it means small firms cannot afford to pay to get the workers. And if you look at the surveys of small businesses, you can see that their complaints about availability of workers are the worst ever. And when employers complain about not finding workers, it's actually they're not paying enough. If they were ready to pay, they would find workers, but they are not able or willing to do so.
Yeah, maybe they don't have the margins or the pricing
Exactly,
power, obviously, that Amazon has.
exactly. Exactly. And given the importance in terms of employment of small firms, I think it's dragging down the average wage. And that's how we ended up with a paltry 30 basis points uh, for last month in terms
Right.
of average wage increase, which is about what consensus expect for the CPI
Yeah.
next week.
But just dig into that for a second. So that seems super interesting. So your view is probably the opposite of almost every traditional media or Twitter or even kind of most bank research, which is wages are coming, they'll come down, they have to come down. But your view is the only way that this is really good. Well, I guess there's two ways, but one of the main ways that this current situation is going to be remedied is by higher wages. And obviously higher wages is not going to have the Fed pivot in the near future. I guess the only other thing is the economy is so weak, people are forced to go back to work because whatever they lost on their investments or what, and eventually people will be forced to go back. But if we're continuing this fairly strong growth, U.S. growth environment, actually, most likely wages will go higher than lower from here. And that's where I think they're quite accurate. And so far on the path, I think most clients still think you're crazy, but they clearly think you're less crazy than 3 or 6 months ago.
Well, I don't think to the
Come around to your view.
I'll stick to the craziness until proven wrong by the data.
Listen, it's been amazing. And this week was with all the pivot talk from one number. And by the way, the US is driven by services way more than manufacturing anyway. But I think your point the whole time has really been like, people can share every like stat in the world about the cost of people from China. But like at the end of the day, if wages are the same or going higher for particular service workers in the US, like the Fed's job's not done. So I don't know what the market is kind of thinking. Anything else? Were you surprised by the market reaction? I guess maybe earlier in the week when the pivot talk, but maybe how equity, the dollar, bonds reacted later in the week or.
Sure. I think people have biases. I think the bias of the market is to look for weaknesses in the economy. I'm trying to keep an open mind both ways. And I think what the market liked at the beginning of the week was fairly bad manufacturing PMI. But the PMIs, I think, have been distorted by the pandemic. Something else I want to write about. But basically, at the outset of the pandemic, there was an enormous increase in perception of uncertainty. And so all the surveys, and interestingly, not just surveys about consumer sentiment, but business surveys like diffusion indices, like the PMIs, where survey respondents are not supposed to say how they feel, but they're supposed to tell you whether they increase or decrease outputs and other things. But even those surveys, which are supposed to be a bit more grounded in facts, they collapsed and then they recovered extremely strongly alongside with the economic uncertainty index.
Yeah.
And I think that's completely warped the surveys and completely destroyed the correlation between the surveys and the real economy. And actually, I put a chart on our Bloomberg chart for our clients in the week showing just that for employment, because people thought that on the basis of that survey, manufacturing employment, NFP would be weak, and they were proven wrong.
The other thing that I'm kind of surprised that people are talking about or maybe incorporating, like we've had, especially now from the 2 million barrel a day cut announced by OPEC plus, like that's a big deal. Like
Enormous.
of all the craziness in the beginning of the year was because oil was skyrocketing, gas prices were skyrocketing in the US and obviously energy impacting Europe. We've had pretty significant 10, 15% moves in just oil. I think gasoline similar. That has to be pretty bad for the bond market. I'm surprised that people are not kind of talking about that more.
I agree with you 100%. This is a big deal. And for some reason, it's completely under the radar screen, but for the Fed, it's a little bit of a disaster, not only because it's going to lift headline inflation, but because they've been telling us, which I think is completely irrelevant, and they are really focusing on the wrong variable, but never mind, they are the guys in charge. I'm not, I can just comment on the sideline. They've been telling us that inflation expectations are very well anchored, and which, maybe, even though it's in actual inflation is historic, but never mind. But the thing is, inflation expectations are strongly correlated with oil prices.
Right.
So it's going to be very difficult to stick to their story.
Oh yeah, how are they going to twist the narrative around?
Inflation expectations are well anchored. And to me, there were a couple of surprises in the past week in terms of the Fed speech. And one of the surprises was a speech by Brennard, who I continue to think of as a dove clause of a hawk.
Right, that's traditionally
She gave a very hawkish speech and listed all the risk to inflation. That's why she started the speech, and which shows that unlike some market participants, she's actually paying attention to the data. So yeah, this is really bad because, the expectation is 75 in November and then 50 in December. But I stick to my guns. I think, especially with this oil price data and the OPEC cuts, it's more likely we'll have 75 both months. And let me just add something that was important and happened last week, which is, of course, the administration is not pleased with the 2 million cut, the 2 million barrel cut. So they started to make, noises about something called NOPEC. NOPEC it's a little bit like the Loch Ness monster of American policies, in the sense that it's something that everybody talks about, but no one has really seen. And it's a law that would declare OPEC a cartel, and so would allow the US to go to the WTO to seek sanctions against OPEC countries, as well as domestically use antitrust laws against OPEC countries. Now, there were, again, talk of NOPEC, but guess what? In fact, Senate Majority Leader Schumer said that, if OPEC didn't behave, he would bring back NOPEC. Nothing is happening. Congress has only very few days left after the election. It's called the lame duck session. And so far, no NOPEC law has been tabled.
Yeah, I mean, it's listen, I don't know enough, but I feel like that would be a bad can of worms open. A lot of the OPEC producers were underproducing even what their quotas were before. I had mentioned actually on another podcast that a wild card could be, considering that Russia's done everything they can on gas, they could voluntarily refuse, to cut exports, oil exports, as a way to, maybe it impacts China, but it looks like even that relationship is not as strong, or they can use it as a threat, and that they would voluntarily try and reduce exports by 2 million barrels a day. Lo and behold, probably half of that 2 million may come from Russia exporting less. And I wasn't counting that they would convince the Saudis to be on their side. Does feel like this is a bad spiral. And I think spreading anything like that is probably not the right thing. Is investing in and producing more oil and natural gas, most likely, at least in the short term. So, all right, let's move to the week ahead. I know Monday is a U.S. holiday. Yeah, what should people be looking out for from data and from Fed speak, politics? Yeah, what?
So the CPI, where the consensus forecast 40 bips for month on month. That seems reasonable, but as always, it's not the single data point that matters. So it's things like trends in core goods, core services, also the trim mean and median.
That's trim mean, right?
So I'll be looking for increases in all of these. Core goods inflation has started to stabilize, which was again my expectation, and I expect that to continue.
Yep.
So this is really the key data point of the week. But to be honest, even if it comes out lower than expected, which is not impossible because these monthly data points are super volatile. With the sort of NFP we got, the Fed is going 75.
Right.
In
It's right.
the other one this week.
So the odds are like if the number is worse, it's almost like the tail is probably if the number is higher. And by the way, I feel like every inflation number in Europe in like 4 months in a row, every possible CPI, GPI, anything has been significantly worse. I can't imagine it that much different in the US. But if we get a bad number again, I wonder if it's off to the races again for markets, which I guess was risk position and stuff.
Yeah, possibly, but I would have hoped that by this time the market has given up on the pivots after the NFP.
Yeah.
And I don't think the Fed would do 100 basis points on the bad CPI.
Right.
I'm actually a bit scared by the pace of their hiking because, I was expecting that after September, they do 50 bips simply because they need to look at the damage they have done, especially in terms of financial stability.
Yeah.
And to me, it looks like having been behind the curve for such a long time, now they are trying to race, but they could just compound their previous mistake by being, so
Do you think after this, they should move to 50, but probably not pause?
Oh, pause. No, I mean, unfortunately, and it's what I've been saying all along. If you are behind the curve, the cost of stabilizing the economy is worse. And pause when the Fed funds rate is still well into negative. You're talking about 3% negative.
Do you think they should move to 50 and then just continue 50 until?
So I'm not, as I keep saying, I'm not the one making the decision. I have to comment on it, which is a much easier position to be in, frankly. But if they don't do, I'd say either do 50 or relax, reinstate the exemption of bonds and reserves from the computation of capital ratio, which is another interesting thing, by the way, that happened last week when Governor Bowman mentioned it as a possibility. There is only so much that the market can absorb at any given time.
Right.
And the Fed has hiked at the fastest pace ever since the Fed funds rate became their operational target in 1982. If I was in Mr. Powell's shoes, yeah, I'd do 50 because you can't pause. You are too far behind the curve, but you don't want to be forced, like the Bank of England, to make a sort of a U-turn because you have badly paced.
Right. Okay, cool. Any other stuff for next week that you're looking out for?
Sure. I mean, the retail sales, and again, I'll be looking for signs of resiliency of the demand for goods. Basically, what we have going on is a long-term change in the structure of consumption, higher demand for durable goods, and that's why retail sales keep, remaining quite strong. And what we've been having as well is a decline in the savings rate, which again would be hinted at by a strong retail sales number. So what I see is actually with the consensus, which I think is 20 or 30 basis points.
Yeah.
I like it. It's strong. It's zero or positive in real term, which is good given the switch between basically non-durable goods and services that we have going on. So I agree with the consensus.
At what point does the increase in debt or reducing savings, personal savings in the U.S. not be a good sign? Like that the consumer may be starting to crumble. And
so that is one of the difficulties the Fed is facing. household balance sheets are super strong. They've been deleveraging for like 10 years. And so they can afford to put on leverage, which will keep the economy going for far longer than, if balance sheets were more precarious. And I would say in general, I mean, when you look at the last tightening cycle, um, household and banks were overextended. So when the Fed hiked, the consequences were devastating. And this time around, I doubt the Fed is facing the opposite problem.
Yeah.
Balance sheets are so strong that the tightening of financial condition, which is very, very significant, is not biting into the real economy.
Yeah, I know.
That's why I'm
Yeah, you've been saying this the whole time when people are like, oh, we're already in recession, we're heading towards a depression. Like, well, if consumers and corporations are in good shape, like this could take a lot more than, and I know that's one of your four core points in your kind of thesis. So, okay, cool. Anything else for the?
These are really the key things. We had the IMF meeting starting on Monday, but this is like sort of a high-powered, shady, lots of lofty languages
Right.
on the what great goals for human mankind and all that. But the bottom line is that there is very little scope for coordination in policy tightening between the US and other countries, simply because their economies are very structurally very different. So I'm not expecting much that could be market moving out of this annual.
Okay, awesome. Well, thank you for another great conversation, and obviously have a wonderful weekend. As always, we invite people who are not clients to please check out macrohive.com and join us as prime clients, or if you're a professional investor, just kind of email me or ping me on Bloomberg. See, it's andrew.simon@macrohive.com. Past week, just on the prime site, this took down a couple of my favorite articles this past week. I think you and Bilal on why this, where people were talking about a Fed pivot, why this is not anywhere close to people to be expecting a Fed pivot, which I think really helped investors and probably saved a lot of people a lot of money. Davir had a great article on on the crypto indices for those following crypto. Bilal had a really good one on don't get caught by the bounds. There's a lot of people were predicting much bigger bounce, even if it was just short covering CTAs coming in and having to buy, and we didn't follow that. I recommend that. And then for professional investors, Bilal's new macroscope, which was amazing. Like how part of the thing was talking about how the US could go about reducing the government massive, was it like 37 trillion dollars of debt by a 4 or 5 step plans, how they could do that. I always check our MacroHive network. So this is favorite trades. And a couple of people have come around to my view, long natural gas. So I personally still like long US natural gas and oil as well. And Bilal kind of had, also another one I find super interesting where we're looking at an underlying asset and then we're looking at the correlations of that asset to say another like 40 or 50 assets to see what's really driving that underlying price movements. And this week we did one on the 10-year treasury, and everyone talked about inflation and other factors, the dollar. Yeah. But what really has been the highest correlation is anything around growth. And that's really been the main driver. So obviously it makes some sense that if we're going to enter some recession, although you and I, Dominique, would agree that even if we enter a recession, the Fed may still keep going if it really looks like inflation is not coming down, which is definitely would be a bad scenario for assets. So everyone, please check that stuff out. And as always, have a wonderful weekend. And investors, be, as we like to say, be a thinking investor. Don't follow the sheep. and obviously check out Macro. So thank you.
Thank you, Andrew.
Thank
Good
you.
luck,
Have a great
everybody.
weekend.